All right, well, welcome everybody to our webinar on behalf of the Fisher Center for Real Estate and Urban Economics. Give us just a couple of minutes here to get everybody loaded in, and then we will get started and make the introductions. Great, well, welcome everybody. We're very excited at the Fisher Center for Real Estate and Urban Economics to have all of you join us. This is our first webinar in a series that we will be starting to try to dive into very essential and critical issues facing the real estate industry, both the commercial and residential side. I'm Chris Hartung. I'm the executive director at the Fisher Center, and I'll be the moderator for today's webinar. For those of you that don't know, the Fisher Center for Real Estate has been one of the preeminent research and educational institutions of higher learning within the United States for over 75 years. We're very proud of the impact we've been able to make to the development and the leadership of the real estate industry throughout the country, and are really looking forward to having the same type of impact over our next 75 years. On this webinar, you can do Q&A. So once the slide gets up here, you just use the Q&A button, put it into the system, and we'll try to get to as many of those as we can. In addition, a recording of this webinar will be available for 30 days after for those of you that can't make it. And please feel free to pass on that information about this session to any of your associates that think could make some use out of what we have to discuss today. So with that, let's just start with why are we doing this? Of course, we know the horrific things that have happened over the start of January down in Southern California, but that builds on what's been happening not only around our state, particularly in Northern California, the mountain regions, but also in areas like Texas and Florida. Insurance is becoming an incredibly critical piece to our ecosystem that needs to be solved, given the severity of disasters that are really occurring across the spectrum, from hurricanes to fires to heat. And so we're really lucky today to have this panel to discuss what's happening within California, how we can help move forward on it, and hopefully some solutions that will allow us not to come back into the state before. Joining me today is first Nancy Wallace. She's the professor and chair of the real estate group at the Fisher Center at the Haas School for Business, and holds the esteemed Lyle and Rosalind Payne Chair in Real Estate and Capital Markets. She's also been doing a lot of avant-garde research into fire and mortgage risk, so we're very pleased to have Nancy on the panel. Nancy's joined by Rex Frazier, who's the president of the Personal Insurance Federation of California, and also serves as the board co-vice chair for the California Fire Safe Council. So brings really those two elements of fire risk and how did we get to have such fire risk and the insurance industry. And then finally, Jason Adams. Jason is a partner with Cock, Castle, and Nicholson and serves on their industry recovery and risk management group. So thank you all for coming. I would also say on behalf of Cox Castle, they are taking one of the leading roles down in LA to help the victims sort of work through this. So we're very pleased to have Jason to give us that really sort of, boots on the ground perspective of how to get through this thing. So with those introductions, let me start, Rex, with you, given your perspective of both, the fire danger within the state, but then also the construct of the residential insurance industry. How did we get into this situation?
Well, on the bright side, I'd like to start by at least saying the insurance industry, property insurance industry in California, continues to believe that wildfire is an insurable risk in California, and that it's a series of public policy choices by the state over an extended period of time that have helped get us to this low point, which we are at a relatively low point. The key to insurers being able to operate in California is to be able to price to the risk that they're going to entertain and to get the approval by the state in a reasonable period of time. The participants in the webinar may not know, but insurance is not treated like any consumer product, really. It's not like insurance companies can just change the price they charge the way a gas station can change the sign on a street corner and offer a new price. Insurers are subject to both price and profit controls regulated by the state. It's quite a complicated formula for a company to demonstrate to the state that it needs to change its rate either up or down. And so the state has to review a filing. That review process is supposed to, under the law, take no more than 60 days, but in reality, it takes anywhere from 6 months to a year. And so if you have a consumer service you're offering where when the underlying costs change, you cannot change your price to meet the increased costs, well, it creates market dislocation. Imagine a realtor where the state says, well, you can only charge 1.5% for commission, not 3%. Well, do you think their business would be the same? Imagine a bank that is told by the state, you can only charge an interest rate 75% of what you're allowed to charge today. Do we think that they would keep the same risk in their portfolio? So on the bright side, our problems are created by public policy, by a rate formula and by a rate approval process that can be improved. It needs to be improved. And starting in 2010, the state just simply didn't allow the price of insurance to keep up with inflation, and that was in an incredibly low inflation environment. Then following COVID, when we had really generationally significant inflation occur, insurance companies were already in a terribly deep hole, and this is after 2 historic wildfire loss seasons in 2017 and 2018. So instead of allowing the price of insurance to gradually raise over time from 2010 to present, where it might have been 3 to 5% in a given year, now we've got companies seeking 20 and 30% at a time. And so for customers, it feels like a huge shock. But if you just look at the average premium charged in California relative to the nation, we're not at all a high-priced state. So we're still going to be seeing average rates in California go up for an extended period of time to get to where they need to be, and that's going to be painful for the average resident.
Yeah, that's interesting. We'll certainly get to what it may mean to homeowners and commercial owners if we don't get some of this fixed. But I think what's a really interesting piece, Nancy, for you, since you've done so much research on this, is certainly the policy dynamics within the state have not allowed the right pricing of insurance to the risk, as Rex mentions, but that risk piece and how we've managed that and where we have been building into the urban, wildlife interface, and really extending that risk exposure at the same time as a state has really even allowed that the horrendous impact to be magnified.
Yes, I agree with that. And I agree with Rex that having a prolonged period where the price of this risk was not obvious, especially on the ground, so that where people chose to put homes and how the riskiness of the wildfire exposure on those locations was informed, or they were informed by pricing that accurately reflected that risk, has led to a lot of sprawl, a lot of urban decisions made by urban consumers and homeowners to put their houses in risky areas. And we sure have had the risk maps that come from the California Department of Agriculture, from CAL FIRE, but they're not that accurate and they're not related to pricing schemes, which is exactly what Rex was talking about. The insurance industry was required to use 20-year backward-looking averages that were not reflective of what was actually going on, especially in things like increases in maximum temperatures, which are driving both the Diablo winds and, more importantly, the Santanas in Southern California, and the fact that looking behind us is not going to help us understand what's going on likely in the future or even presently. And then the second dysfunction of the regulation was that it did not allow the insurance companies to take on additional risk, which is called reinsurance risk, for very, very extraordinary events like the fires in Paradise, like the fires in Sonoma, and now the fires in Pacific Palisades and the Palisade and Eden fires, whereby we can reinsure some of that risk and sell that risk into an international capital market. That the rates related to that insurance was not allowed as part of the rate structure in California. So it's led to myriad problems. We don't have good modeling infrastructure for the insurance companies because some of it wasn't required. They could simply use averages. And we're, as Rex said, we're ramping up very quickly, and quickly as of the end of December 2024, into a world where new rules will be used to actually set prices. And the vetting of that whole process is somewhat opaque, I guess is the polite word to use. So I think we're in a transition period. It's really important. We need to get this pricing right. And then once we get pricing right, we're also going to have to think about helping homeowners to reduce the risk that their homes burn to the ground.
Right, and that would be called hardening.
That would be called mitigation or hardening, yes.
Yeah, so and we'll try to unpack that a little bit. But Nancy, before we leave and we move to Jason to talk about some of the real life impacts of this dysfunction at the state level that his firm is helping people get through today as it pertains to the Palisades and Edens and Altadena. Your research also though shows that we continue to just rebuild in fire-prone areas, correct? That there's a method to the madness, if you will, of fire based on topography, wind, and materials.
Absolutely. I mean, we have amazing improvements now in both climate models, in the data available to build these models, and the work linking insurance actuaries and economists and statisticians with the changing landscape. These are very dynamic models. These are very dynamic risks. And we need an all hands on deck between the scientific community, the insurance industry, and climate scientists, truthfully, to get good forward-looking models to help us price the risk and to provide this risk measurement in transparent ways to homeowners so they know where they're putting their homes, and to cities when they think about the boundaries of the city and what kinds of restrictions they'll put on subdivision development.
And again, put just a fine point so that our listeners can come along this journey with us. Today, right, even though we've had this advancement in how we can model, project because of the granularity of information that is now available and the ability to overlay the risk on actual property maps and types of houses, has not been allowed by the insurance companies to reprice that risk that you say. It's they've only been able to use historical data and loss metrics to be able to go to the state and appeal for new insurance rates. Is that correct?
And that's what that is what Rex is up against and his companies.
Yeah, if I could just amplify that a second, if you think about the way the current system works, the reason why the state was able to hold those prices down from 2010 really to 2017 is because it was a period of time of relatively low fire loss.
That is correct.
So if you're going to project your future losses based on your historical experience, that system generally produces inaccurate projections where they're either too low during times of no fire or way too high after a mammoth fire. And then you produce rate indications that are well beyond what a company would need or even request. And so that feast or famine system has its downsides versus a system that says, I'm going to project my future losses based on a more subtle view of, here's the topography where we're doing business. These are the types of events that can occur. This is the housing stock. This is the defensible space around the housing stock. And from there, you can start projecting what an average annual loss might be for the portfolio you would undertake to protect. But more importantly, if you tell the Department of Insurance, hey, we would like some more risk in our pool, we're going to go into some tougher areas, but as a result, you have to let us charge more.
Yeah.
The state will not let you do that, right? Because
Yeah.
the current system says it doesn't matter where you choose to do business, your future projection is going to be based on your previous losses. So you have a
Right.
system where companies cannot go into higher risk areas because they're not permitted under the state rules currently to charge a higher price for that increased risk.
Yeah. Now, one question before we move on that came through the Q&A. So thank you all that are putting in questions. Again, just so that we can make sure we're not bringing things together that shouldn't exist together. There's a question on sort of the forestry management side of this. And certainly we know there's been huge swaths of the state that have burned that are forests, but that is not necessarily the same type of loss severity that is mispriced in the state, leading to the actual home losses or commercial property losses. Is that a fair?
Yes, that is definitely correct. Sure, there's been beetle destruction in the national forest. There's been lack of forest management. But the source of fire, primarily in the national forest, is dry lightning. And it happens all the time. And we have a lot of dead trees, so that hits that. But the real risk is the interface between the built space, where our cities are, where subdivisions are growing, say in the periphery of Sacramento, which is edging into the foothills of the Sierra, and also the reality that the Nevada Basin, which is a big driver of our fires, the heat in that Nevada Basin has increased relentlessly in the last 2 years. 0.3% or 3 degrees centigrade each year of 2023 and 2024. And the effect of that on the winds, both the Diablo winds and the Santana winds, in conjunction with El Nino, have been very, very devastating. And these are things that are measurable. They're, as Rex says, they're associated with topography, they're associated with vegetation. But this is not really a national forest problem. We have definitely a problem in management of our national forests, but it really is the interface of the built space and topography and certain kinds of vegetation. And we're going to hear from Jason in Southern California. And in Southern California, it's the chaparral and the shrublands that are the real problem.
Yeah, no, very good point. And again, it's such a complicated issue. And the reason I'm trying to dive into some of these specifics is so that we can sort of delineate, some of the real issue that we need to be facing, which we'll get to some solutions about, versus some of the media noise that is real. Like you say, forest management is very real and as an issue, but as it directly links to what's happening in the insurance market in California, it may not be that direct causal link.
If I could
So,
add one.
Jason, sorry, go ahead, Rex.
I was just going to say, if you look at the actual technology that companies use to discern this risk and to ultimately make underwriting decisions where they determine who they're going to accept for eligibility, or rating decisions, how much do they charge if they're going to accept a risk, the principal model for the last 10 years that's the industry standard looks at 3 things. It looks at vegetation around a community. It looks at the hilliness or ravines, because fire behavior changes depending on, if it's going up or down a hill or if it's going up a creek bed, those sorts of things. And thirdly, the ability of firefighters to defend that community.
Yep.
So those are all things larger than a parcel, right? And so you have scoring methodologies used by insurance companies where it doesn't matter what you've done on your parcel, because you are lumped into a community level decision that looks at all these things that are out of an individual's control. And that's why it's been frustrating for so many people, because they do so many good things on their parcel or on their street, but yet they still are held ineligible for regular insurance because of the mammoth problems surrounding them.
Yeah, no, it's a very good point, and suggests one of the reasons. Look, we, like others, the Turner Center at Berkeley, is also looking at this topic from different angles. It really is going to take a community solution and a regional wide solution to help solve some of this stuff. And so, speaking of that regional piece, Jason, talk to us. I mean, first, what you're seeing from the LA community for those that aren't there, how people are coalescing together in leadership to try to help these devastated communities, and then specifically, what you're seeing in helping your clients navigate, these issues that we've been talking about.
Yeah, thank you. So, just for some context, our firm is based in Century City, which is just a couple of miles as a crow flies from the Palisades, right? So, all of the members of the firm were literally watching the app that everyone was on, the Fire Tracker app, and watching the news and watching all this unfold in real time. And each of us were getting texts from, fellow members of the firm, to family, friends, clients, you name it, who were directly impacted. There's countless people I know personally who lost homes in the fire, right? So almost immediately the firm got together and started talking about how we can help people, right? It's a situation that was unfolding on a day-to-day basis, just spiraling out of control. Different information was coming out of different news sources and the internet, and people were drinking from a fire hose in terms of how do we deal with this, right? So we got together, and insurance was on the forefront, obviously, because that's everyone's first question is, should I tender a claim? Who do I talk to, right? But as we started talking to people on the ground, the issues quickly spun off into, okay, what should I tell my lender? Or I can't drink the water coming out of the pipes. There's environmental components. Or, oh, I've already talked to a contractor, in terms of the rebuild and reconstruction process. What should we do there, right? So our firm, thankfully, is uniquely situated to deal with these types of issues because we have different practice groups that address these things. So we put together a wildfire response and recovery team that is just a group of lawyers from these practice areas that can help kind of funnel inquiries and just digest all the kind of big picture meta information that Rex and Nancy are talking about, and put it into a usable format for what people are dealing with on the ground, right? So in terms of me personally on the insurance end, I'm talking to, but even still, a month or plus removed from the fire, 5+ people on a daily basis, right? So that most of them have gotten through the initial claims, they've made a claim, they're engaged with their carrier, they've maybe gotten a different place to live, right? So now the issues are percolating as to what do we do from here? How do I substantiate all my personal property coverage? How do I react when the city or county has a opt-in process that allows me to have them remove my foundation? Should I do that? How does it impact my insurance? Should I pay off my mortgage, et cetera, et cetera? So we're trying to take these people who are, dealing with one of the most difficult times of their lives and digest all this information that changes on a daily basis and guide them through this process that is full of landmines and unknowns. And then that's just what we're dealing with now, right? Like we're going to get into where this is going when they're talking about how do I even get coverage? I can get maybe the fair plan, but how do I supplement it, et cetera, et cetera. And they're asking for answers, and they're asking for what it's going to look like, a month or a year from now. And I don't know if that's definitive answers any of us have at this time.
Yeah, and what are, not only with what you're dealing with, but the community as a large, as you all see it, do you have some perspective, just so those that maybe don't know the magnitude of the loss down there? How many, homes, what percent were insured versus not? And then the second piece would be, from what you're seeing, are there any early indications of how much they're going to be covered by, if they did have insurance, to sort of get through this process and actually rebuild?
Well, good good question, right? So that also involves a little bit of a crystal ball, right? So the Palisades in particular, hundreds of homes were devastated. It looks like a bomb went off up there. I mean, it's there's issues with respect to just getting everyone's brains around in terms of the community, just even the start to allow for these phased county processes to take place, right? Because of the way the Palisades is laid out, there's access problems. They're anticipating 150,000 trucks up there once the rebuild begins. So they're trying to just conceptualize how do we even start to clean up and rebuild this, right? Traffic on PCH, Pacific Coast Highway, is still closed down. There's issues with funneling getting in, so they're talking about putting staging areas in certain remote locations to eventually shuttle in workers. They're talking about putting temporary lots out to store materials when the rebuilding starts. So all of these kind of boots on the ground issues are kind of unfolding as we speak. They're in speaking with government representatives and the people in charge of these processes and some of the homeowners who have dealt with some of the early steps. I mean, everyone's saying the right things, right? We want to rebuild the Palisades and not reimagine it, right? So for those of you looking to just put your existing house in, existing footprint, we're going to expedite the permitting process. We're going to do everything we can to get to a buildable lot within a matter of months, right? But as these issues start to unfold, and there's issues pertaining to the soil and the groundwater and the reconstruction, and by the way, the Olympics are coming, so materials and labor is going to be even at a higher demand. The initial aggressive kind of timelines are slowly, I worry, getting pushed further and further, right? So
Yeah.
to answer your question, everyone is cognizant of these issues and everyone's doing and saying the right things. And I think everyone is trying to row in the same direction, but just the reality of the magnitude of the problem is starting to hit people in the face, and people are starting to adjust their timelines and expectations.
Yeah. And what have you been finding in the process for people that's been uh where you've had the biggest hurdles, roadblocks, or even walls to try to get through on in particularly pertaining to trying to, perfect your rights under your insurance?
So far, it's been surprisingly positive from a policyholder perspective. The things I'm seeing, I mean, there's the big picture issue, right? There's some people that decided to self-insure when they couldn't get insurance or insurance premiums were too high. That group of people, they're high net worth individuals. They didn't have a loan on the property. They have the means to deal with this issue, even though it may be painful, right? Then there's kind of the next tier where they had the fair plan only. So it's a $3 million limit as it pertains to residential construction. So they're coming to terms with the fact that they may be underinsured. And then there's kind of the third tier people that had, your traditional State Farm or those types of policies, maybe with a fair plan supplement. And they're in a better position to hopefully be fully covered for these losses, right? So we have kind of different levels of people dealing with the fallout of the insurance, right? The people with insurance who have made claims so far in this ranges between the different carriers, right? But so far, we've seen significant upfront payouts, mostly going beyond what is required by the statute, right? Especially for the dwelling and personal property. But that process is starting to grind down, and the devil's going to be in the details as to collecting the rest of the money they're owed under their policy, right? So, substantiating the personal property, the contents of a $15 million house by filling out an Excel spreadsheet, noting every teacup, right? And then you can't upload the documents to the carrier server. You have to put it on a USB drive and mail it to a PO box in Georgia, right? That's where the grind is going to happen, and we're going to see the policyholders expressing
Yeah.
frustration and running into roadblocks. But so
Yeah.
far, so good.
Yeah, so let's just pause for a moment because you brought up the fair plan. I think there's a lot of people on this webinar that will know about the fair plan, but there's maybe some that don't understand its critical role in helping insure as the insurer of last resort, if you will. can we just explain the FAIR plan and what we're gonna do with maybe the 30 billion of losses that it now has?
Well, yeah, no, Rex and Nancy will probably be able to jump in on this one as well. But generally speaking, the California Fair Plan was intended to be kind of a stopgap, last resort, kind of supplemental coverage for people who couldn't get coverage in the standard markets, fire coverage in the standard market. So it only covers fire and lightning, right? So if you have the Fair Plan, a lot of people think they're covered, right? But they don't understand they also need a property policy as well, right? So people who have the Fair Plan pay a certain amount, then they have to cobble together other insurance, so the cost can be significant. And the FAIR Plan isn't perfect. It provides some fire coverage, right? But the limits are small, and then there's an ongoing debate as to the nature and extent of the smoke damage coverage it'll provide as well, right? So it was intended to be a kind of supplemental policy that people are primarily relying on. So I think that's just another area that's going to be subject for reform or bolstering or what have you. I mean, the good news is all reports say that the FAIR Plan will be able to cover the losses as a result of these fires, but what happens in the future with the FAIR Plan is, I think, a subject to debate.
Yeah, I'm happy to add on. The FAIR Plan was formed in the late 60s after the Watts riots, and there was availability issues in Los Angeles. And it was primarily a small business commercial function. We're talking about merchants that were having a hard time finding commercial insurance. And it also, the FAIR Plan sells commercial insurance. It also, though, insures a basic fire insurance policy. Remember, when you buy homeowners insurance, it's a suite of coverages. Fire is one, but then water. What happens if a pipe breaks? What happens if it rains and water comes into the roof? Homeowners insurance also covers liability. What happens if someone comes onto your property and slips and falls and you maintain a hazardous condition? Now you have to pay. It also covers theft. What if you get burglarized? So a homeowner's policy is a pretty robust, multi-pronged coverage. But the FAIR Plan is just what's called dwelling fire. And so when you buy something from the FAIR Plan, then you buy most every insurance company has plentiful offerings for those additional items that Jason was mentioning. It's generally referred to as a difference in conditions policy, a DIC policy, that has all of the non-fire coverages that make up your homeowner's insurance suite of products. Now, the FAIR Plan is not a government program. It is a private, the statute refers to it as a private non-voluntary association of insurance companies, meaning when an insurance company sells property insurance in California, as part of getting their license, they must join the FAIR Plan. They must, by contract, subject themselves to the FAIR Plan plan of operations. So the FAIR Plan will always be able to pay claims because it is 100% backed up by the insurance industry. Again, no taxpayer dollars. So the FAIR Plan, they ran out of money, or they're going to run out of money based on these LA fires. And so what they do is they've already turned around and told the insurance industry, we're short $1 billion in order to pay the claims in LA plus maintain the ability to continue operations. And so they've already requested the Department of Insurance approve an assessment of $1 billion in the insurance companies, and that has to be paid on a market share basis. So State Farm at 20% of the market has to write a check for $200 million to FAIR Plan, while State Farm never collected any premium for those losses, and they're already adjusting claims of their actual customers. So, there's no worry about the FAIR Plan being able to pay the claims. The worry is if the FAIR Plan has year after year assessments, is it going to sap the insurance companies of so much money that you have insurance companies then going into financial distress? So the FAIR Plan, it's not meant to be, no one should want to be in the FAIR Plan. It's a catastrophic policy. And as a result, the price is always going to be well above what you could get from a regular insurance company. Even if the regular insurance company was permitted to charge 20 or 30% more, that's still going to be a bargain compared to what you're going to be paying in the FAIR Plan. So no one should want to be in the FAIR Plan, and they only write up to $3 million of coverage limits. And while that may satisfy a lot of folks in Altadena, that's going to be a real problem for people in the Palisades.
Yeah. Yeah. And I mean, it's interesting. So I happened to be at a conference taking this call from the state of Florida, which has its own issues around it. And Rex, I don't know if this goes outside your purview, or Nancy, sort of you too, but I think what's interesting is Florida has, an insurer of last resort as well, but you still have, I think, 1 in 5 Floridians that don't have insurance right now, even with that insurer of last resort.
I mean, there are several differences that are important based on the history of the two different jurisdictions. I mean, Florida just went through a massive fight around what the liability and litigation climate is in Florida, and a fairly aggressive roofing and contractor industry that was driving up the claims payments for hurricane repair in roofing. And prior to their reform in 2022, with only having less than 10% of the homes in the United States, they had over 80% of the home litigation in the United States, right? So there's a particular set of circumstances there that do not lend themselves to an easy comparison to California.
Okay. Well, good. It's helpful to know that we're not in the same bucket. But look, in interest of time, because I want to make sure we get to this, I think that's a good pivot to, we've gone through, I think, look, we have the issues around the structural items because of the decisions the states made. Obviously, we have what's happening because of, the statistical scientific evidence of increased temperatures, which increase, the severity of that. We have, Jason, what you're talking about on the rebuild, just bottlenecks, galore in how you sort of get through this stuff. And I'll start maybe, Nancy, with you on this. How do we even begin getting our hands around what we need to be thinking about regionally as or a state to get out of this mess?
Well, that is a very large question. I think we can sort of break it down into stages, or maybe layers is the right way to think of it. We definitely have to think about how rate requests and rate increase requests are adjudicated by the California Department of Insurance. That is the first order thing that needs to be sorted out. We have to have a rational pricing scheme in this state for risks that are measurable and they need to be insured. So that's a huge issue potentially, but it's really, to Rex's point, this is a political issue and it's solvable. And we need to work with the people that run the CDI and the state government to get these agencies functioning adequately for the risks that they're managing.
And Nancy,
Yeah,
on that point, before we move to the next phase, because I think it's again to sort of put a point on this, let's take State Farm's, emergency proposal to increase
yes,
rates by 22% to
yes,
try to do that. My understanding is, right, that's getting completely slow rolled by the process.
yes.
And that if it gets slow rolled too much, then State Farm is at the risk of a ratings downgrade, and it could potentially put up to 800,000 mortgages on the state in default. If that
They would be due on, they would be, the banks would have every right to require the balance to be paid in full.
the
So
next day.
that's correct, the next day. So that is a huge issue. It's a huge risk. I mean, homeowners insurance, sure, it's about people and their possessions, but who it's really insuring is the banks. It's insuring primarily for the mortgage market, the collateral that the banks have at risk on your mortgage, and that collateral is the structure itself. And so who's really the beneficiary? In fact, many of these policies, the first payment goes to the banks, and then the banks distribute what's needed to the homeowner. So it's for the lenders. That's the intention of it. And that's why the government-sponsored enterprises, Fannie and Freddie, and also Ginnie, have so much say about this market, because they're the insurer of the markets right now in the United States ever since the 2008 crisis. So everything's federalized, and these agencies have say about what is required for them to be willing to manage the mortgage market and securitize it. So that's another issue that Fannie and Freddie right now have certain requirements of what the rating for insurance companies, that are eligible for sale into the secondary mortgage market. And this is a very big deal because 90% of the mortgages are sold into the secondary mortgage market. So not having access to that market is a serious problem for us. Otherwise, everything will be private on the bank's balance sheets, and the banks are stressed already because of COVID, and that is a major problem. So we need the banks to make decisions about these insurance companies, what they will and won't accept. And obviously, if State Farm is downgraded, which it looks like they will be unless this rate increase is allowed, is going to be a very serious wake-up call for upwards of 800,000 people in California. So then there's the issue that Fannie and Freddie won't allow often second liens to do mitigation, to do the hardening we mentioned earlier. Fannie and Freddie have had a policy initiative, at least for certain types of funding, like property assessed clean energy, which might be a way of tax lien funding for mitigation, possibly. The GSEs are opposed to that. And we do need some capital market to fund mitigation. This isn't going to help people in the Southern California fires, but it will help people going forward in terms of reducing the risk to their homes. And it will also reduce the risk for communities that are using California law that exists right now at the community level to do pro or anti total destruction measures, like improving the water mains, undergrounding the overhead wires. All of those things are going to require capital, either in the municipal bond market or on individual loans, home by home. And Fannie and Freddie need to be brought along with that in terms of approving that. And then I want one other comment. I think the insurance industry could also work on plain English in the policies, because a huge dilemma is people don't know what they've purchased. Very few people actually read their policies, even though they might be paying $10,000, $12,000 a year to have the policy. They don't know what the actual words mean. And some of these words in English, like replacement cost value, which is crucial to understand what you actually have just purchased, are very hard to know at the time you buy the policy, because of the point that Jason just made of these surges in costs that mere mortals don't have access to the data to make that decision. And this should be more pushed onto the insurance industry and the regulators of the insurance industry in helping people understand what these surges mean. Or perhaps, and this may be heresy, I'm not quite sure, but we might think about bringing guaranteed replacement costs back as a policy option for people that are willing to pay for it. So the surging and the analysis of that surging could be borne by the insurance companies themselves, rather than homeowners that simply do not have access to that information. So those are kind of the layers that I see that we may very well have to consider. And I think, to Rex's point, that a lot of this is at the community level, like one-lane roads where emergency equipment can't even get up the roads. That is going to have to be solved by communities. They are going to either have to prohibit parking, or they're going to have to widen the roads. And after the Oakland Hills fire, what happened is roads were widened because people realized that the tax dollar implementation is minor compared to the potential loss if you can't get fire trucks up to the neighborhoods that are on fire.
So Rex, how about, so if we start with Nancy's phasing, and we've talked about the issues around the inability of the insurance companies to pass through the true cost of their risk. Are you hearing any change in the dialogue in Sacramento about moving on from this so that we can rebalance the insurance market in the state?
Oh, there's hyper focus on it in Sacramento. In 2023, there was a pretty grand deal that was done, and a bill was formulated in June of 2023, but the legislature just wasn't ready to pass it, just because the politics of this can be difficult. And so in September of 2023, the insurance commissioner said, well, fine, if the legislature doesn't want to do this, I can do it by regulation. And the governor issued an executive order sort of clearing the way, providing an umbrella of cover for all the legalities for the commissioner, and the commissioner moved forward with his announcement of what he called the Sustainable Insurance Strategy, which really did have as its three core points, being able to price to risk, being able to have a reasonable approval time, and making sure that the FAIR Plan does not bankrupt the insurance industry. So in 2024, the legislature they were stuck. They had a chance to act the previous year, but they didn't. The commissioner took this on his shoulders to do by regulation. And so in 2024, by and large, the legislature didn't do anything because they felt like, well, we have to give the career staff at the Department of Insurance time to draft these regulations, which are incredibly complicated. Well, that went the entirety of 2024, and here we are now closing in on the end of Q1 of 2025, and we're still waiting on those regulations to be done. So I think the legislature is starting to grow a little bit weary of waiting, but they realize here we are at the end. Are we really going to interrupt the regulatory process, right? So, but there are a couple things that are preventing insurance companies from being able to make new filings under these regs because they're just not complete. Now, once they're complete, I would expect companies to start being able to have serious discussions about how they can grow again in California, how they can start depopulating the FAIR Plan, how they can mathematically reflect the cost of accessing the global reinsurance market, which provides incredibly needed capacity for insurance companies to grow, and how they can start using more climate sensitive, wind inclusive models to start projecting their future losses. And so we look forward to that, but implementation is going to be tough. Do we really think a novel filing that a company is going to make in probably Q2 is going to get approved quickly? So 6 months would be a boon, right? So we're really talking about new filings being approved, but by the end of 2025 or maybe Q1 of 2026. Then it takes 45 days to implement. So we're still a long way away from the market being able to react under the reforms, and that's got a lot of people frustrated. Got us frustrated as well. In the meantime, we've got to deal with things like the LA rebuild, and generally the insurance industry has not attempted to tell homeowners associations or cities or counties how they need to rebuild. Our job is to signal that the risk associated and corresponding price associated with those decisions. I do think in the Los Angeles rebuild, we will probably have a voice that we haven't traditionally had in the past, urging reconstruction in certain ways. For Palisades, the 2008 building code, known as Chapter 7A, probably is in effect because that's in a wildland urban interface area. For Altadena, I'm not sure it is. So the city council is going to have to decide whether they want to require all rebuilds to be 7A compliant. Beyond that, the insurance industry put out significant building research last year on the 6 best practices for rebuilding, and only the city of Paradise has decided that all new home construction needs to comply with those building standards, and we'll see what LA decides. We're certainly going to be urging that, because it will make those homes more attractive to insurance companies. But then they're going to be balancing cost issues, and people are going to want to rebuild quickly at lower cost, and they're going to say, well, do we build cheap or do we build resilient, or how do we handle that? And that's a question that has to be resolved. And then lastly, within the next month, the insurance industry is going to put out research on urban conflagrations and how to reduce home-to-home transmission of fires like the Palisades or Altadena. And one of the concepts in there is going to be how close should structures be. Right now, if homes are built to the 5-foot setback, you have homes that are 10 feet apart, and our our research, I'm confident, is going to conclusively show that is a terribly close distance, and it's really ineffective in preventing house-to-house transfer. The research is also going to show that 30 feet is very sufficient to prevent house-to-house transfer, but that may not be realistic on lots. And so we're probably going to say, and this is not finalized, but we're probably going to be saying something like 20 feet or more is better, demonstrably better than 10 feet, and may yet be doable. But that's going to be a new position for us to be sort of advocating for minimum building standards. But we want to be in the business of helping people protect their possessions, but and their homes, but that means we're going to have to at least help people understand what the likely eligibility criteria.
Right. Well, and what's interesting about that, right, that goes completely against, in many ways, the density that we're trying to build within the built environment in many neighborhoods. You know, but it does go to what we said earlier, which is if you don't have the community-wide response, because you have the transmission between homes, the whole probability of fire expansion rises the less formulaic you have the whole community, right? So it's an odd twist to this. You really need the whole thing of it. Jason, from your perspective, as you're going through the real-time process of this, are there areas that you look at and say, gosh, this would have been so helpful to have had to help this situation? Are there any that come to mind?
Yeah, I mean, I can just echo what Nancy said earlier. I don't know if everyone saw me vigorously shaking my head. From a policyholder perspective, plain language and clearer policy terms would be a night and day difference. I mean, I'll start back even further. I can't tell you how many people I'm speaking with don't even have copies of their policies, right? Someone likened it the other day to ordering a book on Kindle and they only send you the first 3 pages and then you have to beg them for the rest, right? So uh, that alone would help. You know, clearer terms that we kind of touched on earlier in terms of proving up claims. You know, it kind of switching to more of a valued policy structure like they use in other states, where if you have a total loss, especially as it pertains to personal property, if you have a total loss, house is burned to the ground, you get the policy limit. You don't have to go back and itemize everything you did. So just clarity on policy terms, clarity on the claims process. And to be fair, there is a policyholder component to this as well. I think people have to start reading their policies. It's been kind of a joke for years. I don't even read that thing, right? Like those times are gone. The time where you can go to your broker and say, hey, give me fire insurance, and they pick something off the shelf that applies to everyone, that's gone. You need to get granular on your particular home and your particular needs to see exactly what kind of coverage you need to put together, and you need to work with your broker to make sure that it's obtained, right? A lot of people have this misconception too that, oh, my broker is responsible if I don't have the right coverage. Broker liability is a tough road to hoe in California. You don't want to be relying on that route either. So everyone's got to take some personal responsibility to start paying attention to this coverage going forward. And I think the combination of people actually recognizing their needs, making sure they have the right sublimits. If they know they're going to need an extended time out of the house, make sure you have that ALE coverage, right? And not only making sure you tell your broker that, but making sure that's in your policy. And if the carriers on the back end could give an easier to read policy with more clear coverage terms, I think that kind of base transactional process at the bottom would help everything going forward and would be much more helpful now as we're trying to navigate these claims.
Chris, if
Yeah.
I could just add, I mean, this is a typical trap where the two things that Nancy and Jason are advocating for will result in higher payouts by insurance companies. So it's not that insurers would object to them, it's that insurers object to saying, well, let's pay more than someone documented they lost, or let's depart from court-tested, tried and true language that while being relatively opaque, we also know the cost impact of that language because it's been litigated, right? Because every time you change words in a policy, that's going to get litigated, and someone's going to try to find the ambiguity in it and try to find coverage, because these are adhesion contracts where every ambiguity is construed against the insurance company. So they're generally going to lose if someone says they're confused, right? So if we're talking about returning to pre-Oakland Hills fire world of guaranteed replacement cost, or if we already have plain language requirements for policy language in the statute, so that's not a new thing. But if we're talking about some way that we think we could even make it super duper plain beyond what the current requirement is, those are both going to result in higher claims payments. That means companies are going to have higher rate need. And then we're back where we were, which is there's always a desire to make companies pay more. Let's allow someone just to get their overall contents without showing what things they lost, even if they knew that they had an evacuation order coming and they put stuff on a truck and they drove it away, which, believe me, that didn't happen in this LA fire, but that's happened many, many times. And then should they get their contents coverage when they trucked all their stuff away, right? We know that that's going to be a cost that doesn't need to be in the system, but yet nonetheless it is. So as we have ideas for making it easier to access claims payments, no problem. But let's have a pricing mechanism that allows company to fund those claims.
Yeah.
Yeah. So since we're running up to the top of the hour here, if I summarize with a lot of this, what we've been talking about, it seems that we need to push through as a state some of the reform measures that are in process, but we haven't seen, Rex, from what you were talking about, that speed things up, that allow insurance companies to right size, sort of risk and policies. But of course, that means that our insurance costs, just like where I am here in the state of California, have gone up dramatically over the last couple months. So that's going to be a reality with those changes. But even with that, we're not going to do away with, because of our state and the topography and winds and weather, do away with that risk. What I'd like to end on is just any thoughts on what we can do around financing mitigation measures, both at the urban interface level, but also at the home level itself on the hardening perspective. Is that, if we do that, is that going to be by a home to home perspective, or is it going to be, are there ways that communities can shoulder that cost and disperse that across communities?
Do you want to start, or I can?
I mean, I can say what's happening, and then Nancy and Rex can say how we can address it, right? So from a policyholder perspective, what I'm hearing is, we couldn't get coverage. We got this quote from this carrier, but they're saying I have to put on a new 40-year roof and super 5-foot setbacks and et cetera, et cetera. It's going to cost 60 grand. So I think they're just trying to make me not accept this policy, right? So that's what I'm hearing on the ground. I think people would love to do that stuff, but this gets into Nancy and Rex's area of how we can get it so people can afford it and make it a reality.
Yeah, and I'd love to hear, so we can end on you two, and maybe some positives of how we get through this.
Okay, so I'll say the positive and Rex can counter with the negative. I am very optimistic that we can incentivize both the banks, Fannie and Freddie, and local communities funded perhaps off the muni bond market to actually do this mitigation. So I think we can do it both at the homeowners level and also at the community level. I'm already working with groups to sort of move forward on this. And I think the capital markets can be incentivized to understand the importance of this effort and the wonders of machine learning. We can do censuses of rooftops and what the setbacks are, exactly to Rex's point, and start scaling this market. So I'm pretty optimistic, and I think with the universities and their effort to, again, all hands on deck to solve this problem, that this is a solvable problem. Rex, to you.
Right.
I think it is a solvable problem. I do object when I hear people out there saying that climate change is leading to an uninsurable future. I think that's an irresponsible thing to say, and it overlooks all the things that are within our control. There's no doubt that home hardening, whether it's making sure more homes have Class A roofs or other parcel level things, that's an important piece of the puzzle, but it's not determinative. What will be determinative is the community level mitigation standards that we start to have be commonplace in communities. And I think we're not yet having that discussion, and I'm not sure communities are really ready for all that that means. People move into these beautiful areas, like move into the Palisades where you're looking at these beautiful canyons and it's just mind-blowingly beautiful. Well, the last thing they want is a bunch of that chaparral chopped out of there, or a barren sort of landscape, right? But the vendor models that insurers are going to use, or the ones that are big enough to include their own proprietary approaches, they're going to look at fuel density. That's going to be a critical piece of whether they determine eligibility in a community. And so we're going to hit a point where insurance companies are going to have to do a better job of developing vocabulary that helps communities understand the choices that are in front of them. And then communities are going to have to decide how much of this can be done, particularly funding. Now, that on the bright side, the insurance industry really led a 10-year effort to have Congress finally appropriate federal funds for pre-disaster home mitigation and brush mitigation. Prior to that, you only got post-disaster federal relief. So now there's a program called the BRIC program, BRIC, which allows federal funding to communities for pre-disaster loss mitigation, including brush management. That's a huge thing. Sonoma County was the first one to get a $20 million grant, and we've got a lot of work to do ahead of us on community mitigation.
Agreed.
Well, no, that's great. Look, I hope that that people found this useful. We've got a lot more to certainly unpack. We're learning a lot more by the day with the work that people like Jason are doing on the ground. Rex and Nancy are doing it sort of a more meta level, as Jason put. This is our sort of first foray into helping this discussion. I think you'll be hearing a lot more from ourselves, other members of the Berkeley community, on how we continue to lean into this. So I thank everybody for your attendance, and would welcome everybody on campus on May 6th, where we're doing a really fun program about AI in real estate and whether it's a disruptor or an accelerant to our industry. So very different, but still very impactful for what's going on. So I thank you all for your attendance today. And let's all do a virtual clap to thank our panelists for their comments today. So thanks, everybody, and have a great day.